Buying a home is something many people dream about for years. For some, it represents stability. For others, it represents success. And for many families, it represents the place where life will unfold. But the truth is, buying a home is also one of the largest financial commitments you will ever make. And for most people, that commitment begins with a mortgage loan. So before you sign those papers, before you lock yourself into a payment that may last 20 or even 30 years, there are a few things you should understand. Because once the ink is on that contract, walking away becomes very difficult. The first thing most buyers focus on is the monthly payment. The bank or lender tells you something like this: good news, your mortgage payment will only be $2,300 a month. And for many people, that number sounds manageable. But here's what often gets overlooked. The monthly payment is only one piece of the puzzle. And sometimes, it's the smallest piece. When you own a home, the expenses don't stop with the mortgage. In fact, they're just beginning. You have property taxes, you have homeowner's insurance, you have maintenance, and if you've owned a house long enough, you know that maintenance never truly ends. Roofs wear out, furnaces break, water heaters fail, and plumbing problems have a way of showing up at the worst possible moment. A single repair can cost thousands of dollars. And unlike rent, there is no landlord to call. Now let's talk about something that surprises many first-time buyers: interest. When you borrow hundreds of thousands of dollars from a bank, they don't just expect that money back. They expect to earn a profit. And that profit comes in the form of interest. If you borrow $500,000 over 30 years, depending on the interest rate, you could end up paying close to $900,000 in total. Almost double what you originally borrowed. And that's why interest rates matter so much. Even a small difference of 1% can mean tens of thousands of dollars over the life of the loan. A mortgage is not a short-term commitment. It's a long-term promise. You're committing to making that payment every single month, sometimes for decades. And life has a way of changing. Jobs change, industries change, economies change. If your income suddenly drops, the bank will still expect that payment. And missing payments can quickly damage your financial future. This is why financial experts recommend something very important before buying a home: an emergency fund. 3 to 6 months of living expenses set aside, not invested, not tied up. Simply available when life throws something unexpected your way. Because without that cushion, even a small crisis can quickly become a major financial problem. One of the biggest mistakes buyers make is trusting the bank's approval amount. If the bank says you qualify for an $800,000 home, many people assume that means they should buy one. But banks calculate risk. They don't calculate your lifestyle. They don't calculate your comfort. They don't calculate your stress level. Sometimes the smartest financial decision is to buy less house than you can technically afford and give yourself room to breathe. Buying a home is emotional. You imagine holidays. You imagine family dinners. You imagine children playing in the yard. And those emotions are powerful, but they can also cloud financial judgment. And when emotions take over, budgets sometimes disappear. A home can absolutely be a wonderful investment. It can provide stability, security, and a place for life's most meaningful moments. But it should never become a financial burden. So take your time. Understand the numbers. Prepare for the responsibilities. And make sure the decision truly fits your long-term financial life. If this video helped you think more carefully about taking on a mortgage, follow this page for more finance updates and practical money advice. My goal is simple: to help people make smarter financial decisions that protect their future.